Okay, good evening, everyone. Welcome to another episode of Sequoia Training. If this is the first time that you are here, Sequoia is a commercial lending platform. Currently, right now, we have over 500 different funding sources out there, and our goal is to disrupt the commercial lending industry. We're connecting the business owner, project owner who needs the funding with lenders that we work with. And currently, we have over 500 different lending sources, as I mentioned, that can cover all kind of commercial funding needs, ranging from working capitals to equipment loans to purchasing single investment properties, multifamilies, development, fix and flip, you name it, anything that has anything to do with commercial lending, we have the ability to fund that project as long as that project makes sense. Okay, I always add that to the end. So before I start today, I want to make an announcement first. Okay, many of you is asking for, do we have any free membership available? Yes, the answer is absolutely. We do have a free membership right now, and the free membership is starting in January in this year. So this is how it works. You should receive email, posts on Facebook, YouTube channel, so on and so forth to talk about the free membership. So from this year on, this is how it's going to work. We will, every time when you close a deal, okay, every time when you close a deal, we will refund all the membership that you pay previously up to 12 months. For example, let's say you join Sequoia January of 2024. This year you join Sequoia, and if you close your first deal in April, okay, we pay you the commission, and on top of it, we pay you all the membership that you pay to Sequoia from January to April. We fund everything back to you. Moving forward, let's say your second deal is closed in September. Again, once you close your deal, we pay you back the commissions and plus the membership that you pay from April to September, because from January to April, we already reimburse it back to you, right? So on and so forth. So the goal is to not to get, have you to pay any membership, but we don't want to just open it up for free membership for people to sign up for doing nothing. That's not what we want. We want people to actually come onto our platform, actually see the value of it, and actually utilize this platform to benefit the community, and most importantly, to benefit yourself. Okay, so that is what we have on the announcement. For the longest time, I don't know how many of us in this room has been in commercial lending. For the longest time, for my experience, is that looking for funding for small businesses are the most difficult sector. It's just because the capital is just not in this space. When I say small businesses, I'm talking about business owners that needs anything that from $5,000 to $50,000. Very little money. They need that money to start up their business. They need that money to, to take that first step. And unfortunately, there's just not many capital out there that is suitable for this particular group of businesses. So for the longest time, it's very difficult to find any funding sources out there. Now, the good news, finally, the help is here. In the year of 2021, the federal government approved this particular program called State Small Business Credit Initiative. I have been talking about this thing since last year. The government approved $10 billion of federal funding dollars, $10 billion. And that $10 billion goes into all 50 states. And if I'm correct, California, many of you are in California. California got $1.3 billion. I think New York close to $1 billion, so on and so forth. So every state already got their money, and through the Ssbci. And the Ssbci is utilized to fund small businesses. Now, exactly how does it work? Today, we invited a very good friend of us, Scott, onto the platforms to introduce this Ssbci. So Scott, many of you know that Sequoia right now, we are the consultant for a group is called National ACE. We are on the board. We are the consultant. We are helping small businesses. And Scott is also one of my counterpart that in California, that he's also helping small business as well. So he has tremendous amount of experience in terms of helping small businesses to find capitals. He used to work for Wells Fargo. He was a banker before, but right now he focuses his energy working for an organization called North California SBDC, Small Business Development Center. So he's going to introduce to you what SBDC is all about and what Ssbci is all about, and how you and I, as a Sequoia member, can utilize this unique tool to go out there to penetrate the market. So without further ado, Scott, the floor is yours.
All right. Well, good evening, everyone. I'm from Sacramento, California. So it's early evening for me and later evening for some of you, like in Florida. But yeah, thank you very much, Alan. Thanks for the introduction, and thanks to Sequoia Capital. And yeah, so State Small Business Credit Initiative. I know Alan mentioned that I was going to talk to you about SBDC. So really quick, SBDCs, Small Business Development Centers, exist all across the country. We're a federally funded technical assistance program that exists in all the states throughout the U.S. There's about 1,000 centers across the country, and California is like the third largest state in the country for SBDCs. I think New York is first, and then Florida is second, and then state of California. So SBDCs exist. You can go to americassbdc.org, type in a zip code. You can find the local location in your territory, and you can work with them and your businesses at no cost. They can work with your businesses, help them with projections and business plans, forecasting, pitch decks, underwriting, all this stuff. It doesn't cost you anything, and it doesn't cost the business owner anything, since it's essentially your federal tax dollars at work. So you pay for it, I pay for it, and the businesses don't have to pay anything when they work with them. So it's actually an amazing service that a lot of people don't know about that exists. They help with startups, they help with existing businesses, they help people buy businesses. It's really mostly about startups and lending. So yeah, so really quick, the agenda that we have here today is we're going to talk about the Ssbci. Alan is right. It's about $10 billion nationally. In the state of California, it was about 1.2. And it's good to know that New York got about $1 billion. But each state is running with it differently. And most of it per states, it's housed at the Treasury's office. So in California, it's at the California Treasury's office. This money, Ssbci, was injected from the U.S. Treasury. It's not it's not from the Fed. It's from the Treasury office of each state. So they administer this Ssbci program at their state level in a very different way from state to state to state. So your state is going to be different than California. For those of you that are in California, lucky for you, I understand Ssbci for California, but in other states, they have their own programs, and it's per state. So we're going to talk a little about Ssbci, talk about preparing taxes to help get a loan, starting with the right questions when you're working with your borrowers to get money, what type of funding is available outside of Ssbci, how to qualify for a loan, the lender's perspective, a credit, collateral, cash flow. Some of this might be repetitive depending on who's on the call and your expertise, and then putting your financials and hopefully getting to a yes for somebody applying for a loan. So Ssbci is similar to an SBA loan. So Ssbci it's state guaranteed loan. SBA is a federal guarantee loan. So the guarantee, all that means is that it essentially allows the lender to do a loan that they wouldn't normally do, because it helps them mitigate risk of the borrower, the credit worthiness of the borrower. So they may not want to do the loan for your client, or for you, if any of you are looking for financing. They may not want to do the loan as it was originally pitched or brought to them, presented, but they may want a guarantee on that. So in case the business goes out of business or they fail to pay back the loan, they have that state guarantee for Ssbci, or they have the federal guarantee to help pay back some of that loan if they were to go for a loss. So it is the SSBCI is specifically for SETI businesses, and SETI stands for socially economic disadvantaged individual. So somebody that's like a minority, an underserved, an underrepresented class for nationalities, ethnicity, stuff like that. And so it's to make the underwriting easier. It's not the biggest misnomer with SSBCI and SBA is that SBA is not a direct lender and SSBCI is not direct money. It's not money that goes from the feds to the states to your businesses. It's essentially money that goes from the feds to the states to their treasury's office to help be like an insurance risk. It's not money on the streets like PPP. PPP was from the feds to the treasury to the businesses. So this is SSBCI is just a guarantee for the loans. So it's not direct money. And all the rates and all the terms is specific to the lenders, and businesses must apply to the lenders. Not they wouldn't technically go to the state and apply. They need to go to the lenders and apply. So for those of you that deal with taxes or know about taxes, this may be repetitive. I'm not a CPA or a bookkeeper, but I've been through a lot of taxes with businesses. I've owned my own business. So I understand that there are taxes that you like to see as a business owner, or your business owners like to see. There's taxes that CPAs like to see, and there's taxes that lenders like to see. So they're all different. And the CPA taxes versus what a lender taxes, CPA wants to show no profit, so you don't pay any taxes as a business owner, and lenders want to see profits so that you can pay back the loan. So right now, if you haven't, if you or your business owners haven't finalized their P&L and their expenses, now is the time to kind of do that strategy if they haven't done it before the end of 2023, and see how much they can qualify for a loan. Obviously, the EBITDA, the earnings before interest and taxes, the net profit is what you would use to kind of be able to put together and figure out what's available to pay for a loan. So telling your loan story, whether you're applying for a loan or your business, your clients are applying for the loan, it's all about the story, right? Yeah, the financials will tell their picture. The credit will tell its own thing, then collateral and cash flow. But it's really important for your business owner to know like the stage of business, like when did they start, how long they've been in business, months or years, how much they need, what are they going to use the money for. It doesn't have to be down to the penny, but it does have to be kind of clear. So you can't say, if a lender said, hey, how much do you want? And you said, I don't care, whatever you can get me. Unfortunately, that's the wrong answer, and they won't take you seriously. You should kind of know how much you need, what you're going to do with it. Obviously, it's important as the borrower to know their assets, what they own, liabilities, what they owe, and then really how are you going to pay back the loan? That's really all the lender kind of cares about. Are you going to be able to pay back the loan? Is that from your personal income, your business income, future income, projected income? And the lender wants to know who the owners are. Usually anybody over 20% will have to do a personal guarantee. Does the business make money? Are they profitable? And then depending on how long they've been in business, have they, experienced any disaster, and how are they able to kind of jump back from it? So startup versus existing. So startup is it's a general term that everybody seems to have their own made up description of what a startup is, depending on how long you've been in business. So most SBA lenders say that you are a startup if you haven't been in business 2 years. And most traditional conventional banks across the country say that you're a startup if you haven't been in business 3 years. So some are 2 and some are 3. To me, a startup is something that's an entity that has been existed in 6 months. They started, they launched, they have some revenue. They may have not hired anybody. They may not be profitable, but they started, like they're 6 months. So, they could potentially qualify for an established business depending on the lender. So this is just a side-by-side comparison for SSBCI. And this is this example that you see on the loan limits is for anything that's not a building. So for a building loan on SSBCI, you can go up to 20 million, or like a large project. It could be 20 million. And that's in the state of California. I'm not sure how it is in other states, because the loan limit is specific to the lender. And in the state of California, the loan limits for SSBCI is up to 20 million. But most loans nationally for SSBCI go from 5,000 to 5 million. Down payments for startups are higher. They're much larger than established businesses. The rates are the going rates. US prime rates at 8.5. Sometimes you can get a little bit lower for an SSBCI or an SBA loan, depending on the lender. Payback terms for anything that's not a building is 5 to 10 years for like a micro loan or something like that, or nonprofit lender. If it's a building loan, obviously it's a lot longer term. It could be 25, it could be 30 years. Collateral is usually always required for a startup if they have it. If they don't have it, then you obviously can't do anything with that. And established businesses, the collateral it's always asked for, but there's a way that you can get around it where you don't need collateral for an existing business. Additional notes is for startups, obviously all the terms depend on the lender. That's how it is for business lending. It's case by case, it's lender per lender. It's not SBA versus SBA or SSBCI versus SSBCI. If you have a borrower that goes to a bank and they do SBA and that bank declines them for SBA, it doesn't mean that SBA declined the loan. It means the bank declined the loan. We need to stop blaming SBA. It has nothing to do with SBA, has nothing to do with SSBCI, has everything to do with the lender. And the lenders don't want to disclose that. They don't want to disclose that they weren't able to do the loan for whatever reason, so they blame it on SBA or SSBCI. But for startups, you are going to need projections, business plans. For established businesses, you may need an expansion plan and a condensed version of a projection plan. So for startup loans, this is really important to keep in mind. Your borrower should have experience in the industry. It's not like they work in the restaurant industry and they want to start a tech company, or, it has to kind of be, they have to have industry experience. Like they can have the best credit, the best collateral, and the best cash flow, but have no industry experience, and lenders won't fund to them. So industry experience is important. If they don't have it, then they need to grab somebody that has it and give them ownership of their company. So it's all about structuring the loan. We kind of went over this. So personal guarantees are always required for startups and existing. For 90% of the financing in the country, personal guarantees are always required. Collateral is recommended, but not mandatory. Credit score minimum depends on the lender. The rate, the terms, all depend on the lender. And then, you could grab a spouse or a girlfriend or a boyfriend and add them to the loan, kind of like a cosigner, and they don't need to be part owner. And you can essentially add their income to help qualify for a loan. And then projection-based loans are possible, meaning, they don't make any money and they use projections to qualify for the loan. So existing business loans, most time you don't need a down payment. Again, personal guarantee is always required. Collateral is recommended. Credit score terms, all that stuff is dependent on lender. So starting the loan process, pretty much everybody is bankable, right? Like everybody says, are you bankable? Well, we can all put money in a bank and be bankable, right? The real question is your business fundable? Will somebody fund you money or lend you money or give you money? That's what it comes down to. Can you afford a business loan? It's oftentimes asked for entrepreneurs and businesses, how much is it going to cost me for a loan? And simple math tells you that on a 10-year loan, for every $25,000 that you want to borrow, it'll be roughly $350 a month. So they would need to cash flow $350 a month. They would have to clear that. So 350 times 12 is like 4,200 a year. So they would have to clear 4,200 a year in profit to be able to afford a loan of $25,000 on a 10-year loan. Most loans out there that are not building loans are 10-year loans, whether it be SSBCI or whether it be SBA. So if they want a $50,000 loan, the real quick math, it's $700 payment. So that's real quick to see if they cash flow. So looking at different loan options, there's so I'm in California again. I know a lot of you, some of you are in California, some of you are in different states. There are national lenders out there. So Lendistry is a national lender. They're a national SSBCI and they're a national SBA. So they're kind of like a unicorn. They'll do loans between 50,000 and 5 million. Sometimes they might go below 50, but they like to stay right around there. And they also do contract financing. So if you have any businesses that get paid from the state and the feds, and it takes really long for them to get paid back, like 30, 60, 90 days, they do 2-year contract financing, depending on the contract and the invoice, which is pretty awesome. It's kind of unheard of out there. TMC Community Capital, they're a California lender. For those of you in California, they lend in California. You do have to be in business 1 year. They do SSBCI and then non-SSBCI. They're traditionally between 5,000 and 25. They do bank statement financing. So what that means is that they sometimes may or may not collect the taxes to qualify for a loan, which is really awesome, kind of unheard of. Most lenders want a full underwriting, taxes, P&Ls, personal financial statements, all that stuff. United Midwest Bank, they are a national lender. They're a transactional lender, meaning you don't actually all these lenders on here are transactional, meaning you don't have to bank at them. You don't have to give them money for depository to get the loan. You could just get a loan from them. United Midwest Bank is, I think they're in Florida, and they do SBA financing 25 to 150. They'll do it for startup and existing, collateral and no collateral. And they do lending. They can do it super fast too. If you have all your financials, you can get a loan within 3 to 4 weeks. You just have to kind of know how to navigate their process and have all your stuff together. So reasons why lenders would decline a loan. Industry, they don't like the industry. You don't have enough cash flow. You don't have enough cash flow to pay back the loan. They didn't really care or listen to your projections. Credit issues, obviously, collateral, credibility, so lack of experience in the industry, and then how long you've been in business. So those are some of the reasons why they decline. There's a lot of other reasons, but they may not disclose them to you directly. I used to work at Wells Fargo, as Alan mentioned, and Farmers and Merchants Bank of Central California, and did a lot of commercial lending and business financing, and had to have those hard conversations when you say no to people. And there's the disclosure that lenders give you when they decline you, but it's super vague because they're regulated and they're not allowed to tell you like everything behind the scenes. But then there's some bankers out there that will actually have a real conversation instead of a robotic conversation and tell the borrower really why they got declined. But just kind of, if you're working with a borrower and they got declined, it'd be really good to know the real reason they got declined so that you know how to work backwards and then pitch it to a lender in a different way. So alternative financing, Alan mentioned that they have 500 lenders on their platform and growing. There are thousands of lenders across the country. There's about 5,000 SBA lenders across the country, and then about 5,000 alternative financiers across the country. And so there's a lot of lenders out there. And there's also different platforms of funding that exist. So there's city and county loan grant funds that exist, nonprofit, SBA and guarantee lenders, micro lenders, CDFIs is a certified development financial institution. So nonprofit lenders are not banks. So you won't see any banks on this list because this is all non-bank financing that exists. Like if you have an old 401k, you can flip it into a C corp. You don't have to pay any taxes. It's really awesome. You don't have to pay it back. You don't get penalized. There's crowdfunding, equipment financing, online lenders, and then equity VC financing. So there's lots of financing that exists. It's just important to know when you're working with your borrower or yourself and you're looking for financing, how to structure your loan and how to tell the story. And that's really what this is really all about. You're selling yourself or you're selling the business and you're pitching it to somebody instead of a VC or angel investor. You're pitching it to a bank or a lender to give you money. That's really what you're doing. So building loans, for those of you who want to buy buildings or your businesses want to buy buildings, there are SSBCI guaranteed building loans. Obviously, there's SBA 504 and SBA 7A, but 504, you only need to put 10% down, and then you have a 90% guaranteed loan, which is awesome. And so the rate comes with the lender. There's an SBA rate and then there's a lender rate, and they do like a blended rate. So that rate changes all the time. So I don't have it here on quoted, but there's conventional lending where you don't need a SBA or SSBCI guarantee. Usually you have to put more money down. The rates are a little bit lower. And then there's obviously hard money. Everybody knows about hard money. It's it's money that you can get like in 3 days, super quick close, but you have to pay for it. It's a lot of money, but it's usually no prepayment penalty. And it's well, you guys all probably know about hard money. Yeah. So qualifying for a business loan. So whether you're trying to apply for a loan or your clients are trying to apply for a loan, lenders talk a lot about the 5 C's of credit. And I just really talk about the 3 C's, because the other 2 C's don't really make any sense when you're talking to a business owner about it. But they can understand the credit story. Like, my credit score is 640 because I had a bankruptcy 10 years ago or 7 years ago, or I went through a divorce and I had a short sale, or I lost my job and I had medical bills, or whatever the story is. There is a story behind that. So it's not just about the score. Because TMC Community Capital, the one I mentioned, they don't really care what your credit score is. They just kind of care about what's on your bank statements. And then, so credit is really important. How have you been able to rebuild it? Collateral is extremely important. They're always going to ask if you have collateral. Usually, if you have more collateral than they need, they're going to give you the loan, like kids and everything. They're going to take it all. Cash flow is very important. Obviously, are you going to be able to pay back the loan, whether it comes from your business or it comes from your personal income? That's really important to know about. Startups are different than existing businesses. Obviously, startups, the money would come from the person, and then businesses, the money would come from the business. And then, why is collateral needed? Well, the lender really wants to reassure themselves that they're doing a good loan, and that their stakeholders and their really their stakeholders of the bank knows that they're going to make money, and if they do, this business does go out of business, they have peace of mind that there's some risk assurance with the loan. So the SSBCI and the SBA are what's called credit enhancements, credit incentives to lenders. So they feel more comfortable doing the loan because they have that extra collateral. So everything depends on the lender. Like, when you talk to lenders and you say, hey, do you do startups? And they go, well, it depends. Do you do gas stations? Well, it depends. Do you do restaurants? Well, it depends. And it's really hard for borrowers to navigate that. So it's why, Alan and myself exist to help, and that's why SBDCs really exist, to help navigate that process, and coach and work with the business owner to get through the process. But for collateral, there's different percentages that are asked for different lenders, like whether you need a 50% collateral or 100% collateral or a 2000% collateral. It's all different per lender. So cash flow, again, if you're a startup, your cash flow is going to come from your personal income, your W-2. So if you have a job right now, or your businesses have a job, they should not quit their job before they get a business loan. They should keep their job, and in their business plan, they can say they're going to keep their job, but they just need that income to qualify, because we all know projections are made up. And if the assumptions don't back the projections and the industry numbers don't make sense, the lender won't give you any money, regardless of what your projections say. So for a startup, it comes from your personal income, you and your spouse, or other owners that are 20%. There's existing business income. Then that's the EBITDA, the earnings before interest, taxes, depreciation, and amortization. And then the startup business projected income. And then for cash flow, they look at your personal debt as well as your business debt. If you're an existing business, if you're a startup, they only look at your personal debt because that's all you have. And then they will add back the new loan debt to help you qualify. And then there's different lender debt to service ratios, depending on, and we'll go over those in a little bit. But personal income, obviously, all of you do your own personal taxes, or you have a CPA, so you know what personal income is. There's all these different schedules and what they mean. But essentially, you can use all this personal income to help qualify for a business loan. It's really awesome how it works. You can do that. So then existing business EBITDA, So earnings before interest, taxes, depreciation, which is essentially net profit, or net profit then with the add backs. And this is a highly condensed version of what a P&L would be. It's just written form. If you need more information, we can get it to you. But essentially, you take the revenue, you minus the cost of goods, if you have any, the cost that it takes you to get your product or service out to the market. And then you take that minus that, you have your gross profit, and then you minus your expenses, and that's your profit or loss. And then if you have any interest, taxes, depreciation, or amortization that you took out, you can add that back. That'll add to your profit. And then if you have any unexpected one-time occurrences that happened that year, whether you merged and you had a bunch of legal fees, or you had unexpected health expenses, inflated salary, stuff like that. This slide actually kind of goes back to that original slide that I talked about for tax preparation. So if you had any of these crazy one-time occurrence expenses, this can help you qualify for a loan, even though you can decide to take it out or take it over a couple of years. All right, so credit worthiness, how funders rate you. Again, they look at the 5 C's of credits, 5 C's of credit. This is all of them right here. But it really comes down to like your credit score, your story, do you have, are you worthy of credit? Are you worthy of them extending money to you as a business? Can you afford the loan? Will you honor the debt obligation? And it is per lender. So lenders have different levels of worthiness for credit, whether they like your industry, or they like how long you've been in business, or they like your cash flow. But the great thing about business lending compared to consumer lending is that business lending is essentially super customizable, super flexible. They have restrictions and guidelines, but they don't have to listen to them. On consumer financing, they have to list there all these regulations. If the minimum is 670 credit score, they can't go lower than 670. But on business financing, if the credit score minimum is 670 and you have a 650, but you have a bunch of money in the bank, they can make an exception. And they do it all the time. So business lending is super customizable, super flexible. You pretty much do whatever you want. It's like the wild, wild west out there. But it is flexible. So the summary of the credit, again, I did a presentation a couple days ago for National ACE that Alan was talking about, and there was somebody on there that asked about business credit scores and how often do they use business credit scores. And business credit scores are something that banks and lenders never tell you. They don't tell you. They don't tell the borrower. They like hide it. They talk about it amongst themselves, like behind the scenes. Business credit scores do exist, but they're not used for business financing. So Experian has a business credit score, but it only goes up to like 100. We all know that personal credit scores go from like 0 to 900. So when you're applying for a loan, whether you're an existing business or a startup, it's all based on your personal credit score. It's all based on you as the entity, owner, person, human of the loan, based on your social security number. It's based on all personal credit. So if you don't have great credit, then you need to write a letter of explanation as to why your credit sucks, or why it's below 720, or why you had a bankruptcy a year ago, or why you have delinquencies on credit cards. Whatever it is, you do need to explain it. And you can, it helps the banks like mitigate risk. Should we lend to you if you had a short sale 5 years ago? And then looking at credit for startups and existing businesses, again, regardless if you're an existing or startup, they're gonna go on your personal credit. And the risk is really just all on the owner for a startup, obviously, since the business has no historical data. The existing business, the risk is kind of a little bit on the business, but it's mostly, again, on the owner, on the personal credit. So credit scores do matter. I'm not gonna lie to you. Like if you have an 800 credit score and you have a 600, a person has a 600, so one has an 800, they're more likely going to give the 800 person probably better rates and better terms, and they're probably not going to really need an Ssbci or an SBA guarantee on it. But loans are really based on risk. The pandemic kind of messed it up for everybody, kind of tightened it. The way the economy is going with the rate structure right now and affordability, before they raised the rates, you could you could probably buy $1 million building and afford it, but now you can't because of the rates and the cash flow. But yeah, so credit score does matter. And like I said, it's not all about the score. It's also about the story. So there's the story behind the score. Why is the score the way it is? You're with credit, it's a catch-22. Like they get mad at you, you get dinged if you don't have enough, you get dinged if you have too much, you get dinged if you haven't been in the States long enough, if you're from abroad and you haven't had credit for 5 years, you get dinged. It's pretty nuts how the credit works. Um, and like the FICO scores and stuff like that. But how much do you owe on your credit card, stuff like that. All real important to know. This is a real quick chart of what's needed for credit based on the different types of financing that exist out there. So you don't need a credit score if you're gonna do like hard money lending or like you just need the collateral, right? That crowdfunding doesn't care about your credit score. VCs, angels don't care about your credit score. But if you're all doing traditional bank financing and you're trying to get loans for your borrowers or yourself, this is kind of like a quick down and dirty chart. Ssbci and SBA will go as low as like 600, 640. And then obviously they'll do higher FICO scores as well. But this is just a quick down and dirty, based on your credit score range where you would fit for financing, traditional financing. So if your credit score is low, like in the 600s or 640, 650, under 670, then maybe you have more collateral that you can offer, or your spouse does, or your friend does, or your business owner does. Maybe you have more cash flow that you can give to the deal, whether it's from a spouse or another business partnership. And then obviously they'll look at the federal or state guarantee, SBA, Ssbci, or you just have supporting documentation for like why your credit is insufficient for them. And then just more mitigation of risk. So what you'll find on this presentation is that I used to work at a bank, commercial lending, SBA lending, and micro lending. And what I found as borrowers when they're working with lenders and trying to qualify for loans and get declined is they just don't understand the jargon or the verbiage on how to pitch it to a lender. So some of these tips and tricks on my presentation here is just like how to navigate that process, how to advocate for your borrower or your clients to when you're working with lenders to get to the next step so that you can speak the language and kind of help negotiate, tell a story better. Usually when I work with borrowers, I don't let them talk to lenders because they'll say the wrong thing and it'll eventually kill the deal. The lender won't do the deal because they said something wrong or they gave them too much information. And but it's really important to kind of know how to navigate this and how to help mitigate risk so the lender feels comfortable doing the loan. Cash flow. So you hear from lenders about different debt service coverage ratios or debt to income or all these different ratios. The big banks use these 1.25 or 1.35 to 1. So I have a quick scenario on here real quick. I obviously I got like the first bullet point is a joke. If the cash don't flow, the loan don't go. Just kind of interesting tagline to think about. If they don't have enough money to pay back the loan, they're not going to get the money. Do they need to add a spouse? That comes up a lot, and then you usually, but the debt to income ratio. So if your monthly income is like $1,250 a month, and then your debt payment, including like all your personal debt, like your mortgage, your rent, all the stuff, your credit cards, car loans, and then you add the new business loan. If you take 1,250 and divide it by 1,000, that's where the 1.25 comes in. But Ssbci lenders and SBA lenders will go below 1-to-1 ratio. They'll go at 0.8, meaning you make $800 a month and you spend $1,000 a month. They'll go below 1, even though they say they won't, but they will, because they'll do what's called projection-based lending, and the projections will help pay for the cash flow for the loan. So there are banks and lenders out there that will go below 1, that'll go below 1.25. They do exist. You just need to know how to navigate it. and tell the story. So, you can just ask more questions to the lenders, and maybe you apply for too much and need to ask for a counter offer. Maybe you need to add somebody to the loan. So lenders will not structure the loan for you because it's against the regulations and conflict of interest. So that's something that like we do at SBDC. It's something that Alan, I'm sure, helps his clients with, but you can help structure the loan and kind of put it together. And essentially you're just kind of selling your loan request to the lender or the funder. And again, business loans are super negotiable. So getting down to like the end of the presentation, it's important. Obviously, you have to put your financials together. So all the previous slides is most of that's all practical application, putting it into process, working with your borrower, helping them get to the next level, doing all the dirty work before you submit your loan package. And then these are the financials that every lender needs. They are going to need a personal financial statement, which is essentially is their personal guarantee. They're going to ask for bank statements. If you have a W-2 job, they're going to ask for your pay stubs to help qualify for the loan, usually used most in startup loans. Obviously, your current year-to-date P&L, balance sheet, stuff like that if you're an existing business. And then they always look back 3 years, personal and business taxes if you're in business. And then just more financials. Depending on the lender, they may go back as far as 19 because 19 was before the pandemic and 2020 was like a year that didn't happen. And then 21 was kind of like a half a year that didn't happen. And then 22, we kind of got back on our feet. And then 23 was last year. So you're not going to have 23 taxes if you're applying for loans right now, obviously. So they're going to look at the year-to-date P&L, profit and loss, and balance sheet for taxes. Sorry, for your previous year historical since you don't have taxes. But and they are going to ask for a personal financial statement for all owners over 20%. They may ask for a business debt schedule. Most borrowers that I work with have no idea what their credit score is, so I usually tell them to go to annualcreditreport.com or Credit Karma, just so I know what we're working with, based on if they have any blemishes and kind of how to pitch that or navigate it to the lender. And I think this is my last slide. So this is making it easy to work with a lender and get them to say yes. It's like quick summary. So, come prepared when you're working with lenders. So I'm not sure if you're going to be working with your borrowers or Alan's going to help you, or somebody else is, but if you're working with your clients, or you're trying to apply for financing, it's really important for you to do all the pre-work that we talked about in the previous slides, like to know how much you want, what you're going to do with it, with the use of funds, explain, how your business is going to pay it back. And then the full disclosure of all your financials and personal financial statements and collecting those. So I know it's a lot of information, but not sure if Alan has some questions.
Okay, wow, great. Thank you so much, Scott. Absolutely, there's a lot of inside information that personally I've never heard of. How you guys actually underwrite the loan, how do you look at the credit, so on and so forth. That's definitely a good thing for us to understand as well. So one more thing, ladies and gentlemen. So whatever Scott shared with you, there's a lot of inside information. Now, if it is too much information for you, don't get overwhelmed. This is not what Sequoia's platform is. So as we mentioned, we do have advisors behind the scene that can help you to package this thing, just like Scott said, to put the story together, put the package together to sell it to the lender. So that is what the platform is going to do for you. So all your job is to go out there, go to the community, let the community know that you now have the ability to access to all these funding, all these lending sources, and bring the customer onto our platform through your own portal. And we will have advisors to collect the paperwork for you, to send you a list of documentations that we need. So you don't even need to know exactly what you need. Because again, Scott already gave us a list, and we will send that list to you. We will ask you, we will talk to your client directly to collect the documentation. And all you needed to do is to help us to push your client to send the documentations to us. And oftentimes we cannot get a deal closed. It's not because the deal is not good. It's not because it's not fundable. It's because we have lack of information. Whatever we ask for, the client might be too busy to submit it to us. And it just never happened. So you, as the Sequoia loan consultant, your job is to go out there to talk to your client and make sure that they work closely with us and you help us out. Okay. So again, there's a lot of information to digest. That's for sure. But I want everybody to remember one thing: there's a lot of resources out there through the Sequoia platform that you can tap into, and obviously, California, it's one of the main battleground. And Scott is in Sacramento, and I believe there's a few of us in California and live in Sacramento right now. And tentatively, I was told that we are going to have a meeting in Sacramento on February the 24th. So again, once that is settled, once that is confirmed, we are going to announce it to everybody. Yes, absolutely. California, you will see the Ssbci. And along with Ssbci, there's another program also coming to California. Is called the Electrify California, where Scott and myself also got involved. So next week, and another gentleman, Ricardo, is going to be here specifically talk about Electrify California. So there's so many things going on in the state of California, and that's why we're saying that is going to be our major battleground. But at the same time, it's not just happening in California, it's actually happening all over the country as well. But it just happened to be that California is a huge state. We have a lot of resources. We have a lot of help, like Scott and Ricardo with the Cal SBDC and also National AIDS. We can tap into a lot of resources. So again, ladies and gentlemen, I mean, any questions that you have, there's a question right here saying that, asking us, Scott, can real estate agent, loan officer get business loan like this?
Yeah, they can. Yeah.
Okay. Okay.
Yeah,
Benji, just go ahead and apply.
Yeah, they can. Yeah.
Right.
Awesome. Thank you.
So if you don't apply, you never know, right? So there's another question is by Teresa. She's asking, what does it mean by owner with over 20%?
Yeah, so if there's multiple owners, if you take like 100% pie and there's 3 owners, then they would all own 33%, or 2 would own 25 and 1 would own 50. So it's all owners over 20% equity, 20% ownership of the company, have to give a personal guarantee. So, and then there's different requirements. So like if you have 10 investors and they all own 10%, if none of them own 20% or more, then you just have to kind of add a bunch of different people together and get at least over 51%. So there is some exceptions to the rule, but most time anybody that's over 20% will have to give a personal guarantee.
Right. Okay. Tim is asking, do we have flyers? Yes, absolutely. Flyers all over the place. Flyer is already in the back office. You log into the back office, look at marketing. There is a tab out there called marketing flyers. So click on it. And if you don't know where to get the flyers, always go back to our YouTube channel. There's a little video, 2-minute video to show you where to get flyers. Okay. Very informative. Great. Any other questions?
Hey, Alan, this is Mo.
Hey, Mo.
Quick question. How does this affect the trucking industry?
Oh, the trucking industry? It's not, I mean, it doesn't affect it either way. Most lenders struggle with trucking in general. So Ssbci or SBA as a collateral support may be able to make lenders feel more comfortable with it, but trucking in general is a tough industry for lenders to fund.
Yes.
Yeah. So
we do have
Ssbci would probably make it easier for lenders to do the loans, but it doesn't, affect it directly, I guess you'd say.
Right. So the best thing to do, Mo, if Ssbci cannot do it, SBA cannot do it, like you said, we have other alternative funding source that can fund trucks like this. And as a matter of fact, we are working on a deal that it's the gentleman owns 4 18-wheelers, and all free and clear. We have lenders that can actually cash out from those 18-wheelers for him to purchase another 18-wheelers. So we do have options like that. Okay.
Excellent.
Victor is asking a question: how will we know if and when this is the best option for the client? And that is what the advisor comes in. to look at the deal. So all you have to do is to submit the deal to us, and by looking at the number, and that is why the scenario form is very important. When you submit the working capital scenario form to us, we looked at a few things. We looked at number one, how long they've been in business. Now, if they've been in business for over 3 years, 5 years, 10 years, whatever that might be. Now, obviously, SBA loan might be a better option because they might qualify for SBA loan much easier. Or if they've been in business for only like 6 months, so most likely it's going to go to Ssbci. We also look at what they're looking for. If they're looking for $1 million loan, then most likely it's going to be SBA loan or term loan or some other financial products. But if they're looking for only $10,000, so most likely it's going to be these micro loans and go to Ssbci. So you as an agent, all you need to do is to ask your clients to fill out their information. And once it comes in, our advisor is going to review it and send you a list of documentations to collect. Then we will structure the deal for that client. Okay?
Is there a cap on the fees and points that we can charge in these type of deals?
Yes, I mean, again, that is something that depending on what the deal is. So sometimes we can only charge a flat fee. Sometimes we can only charge a point. It really depending on what the deal is. Then obviously for business loan, we will no longer we cannot charge more than 1 point. Okay. But again, I want everybody to see what the magnitude of this thing, because you are getting into a relationship business with this startup company. Once they start up and they stop getting funding from you, they are not going to go anywhere. They will keep coming back. They will keep coming back. And our goal is to grow together with this client. So for example, right now we are funding a client. We're funding him $100,000 for his business. Now, after he got funded, now it's ready to purchase the building. Right now, he's actually in an e-commerce business. He needs the $100,000 to expand the business to purchase more inventory, but now he's renting right now. So after he got the $100,000 and when he is able to, expand his business, now he's ready. This year, he's ready to come back and purchase a building for his business. So you see, once this client attached with you, they will attach with you for a long period of time. So ladies and gentlemen, when you are in the Sequoia platform, don't just think about just funding one time. Don't just think about one loan. You're thinking about you are growing together with a business. And that is going to be 5 years, 10 years, and hopefully a long time to come. And they will keep coming back to you for fundings. Okay. Teresa asked, where can I find the form for the deal intake for my client to bring in? Yes, Teresa, if you are a Sequoia member, and you will have your own web page like this. Let me share that with you. Hold on, let me see if I can share. Okay. Okay, so this is our web page. When you sign up as a Sequoia member, you will have a web page like this. And when you go to a web page like this and you see the product right here, you click on product. And this is all the product we can offer to our clients. Now, whatever Scott is talking about, it's called working capital. You click on working capital, you click on apply, you fill out some basic information. And once that information comes to us, then we determine if this client is going to SBA loan or Ssbci or term loan or so on and so forth. Now, give you another example. Let's say the client is like Mo said, there's a client that need to purchase a truck, and all you need to do is just come in here. You see, we have a truck and heavy equipment scenario. All you have to do is just click on it, and again, apply for it. Once it comes in, then we will respond to you with a list of documentations to structure that loan. Let me see. Okay. So, any other questions, comments, suggestions? Excited? Not excited? I think
news. Very informative. Very informative.
Yes, you are hearing from the lender, ladies and gentlemen. Hopefully, you can see the impact. You can see the value of this platform. You're literally listening to the lender who is actually underwriting the loans. So he told us how to get the loan qualified. And plus, right now, he is on our side. When we have a loan that's submitted in, and guess what? I will work together with Scott to make sure that all the documentations are actually complete before we send it to the lender. So again, we have people like this, we have advisors like this on our platform that can help our client. So your job, ladies and gentlemen, go out there, be confident, be proud of this platform. And we have unlimited resources right here for you to provide it to your client. Think about how big that market is. It's basically an untapped territory. As I mentioned, anything that below $50,000, from $10,000 to not even 50 to $100,000, this range is very difficult for them to look for any funding. And now we have the resources for it. So go out there, guys. Don't be just sitting on the sideline. Go out there, make yourself a commitment. Today is the last day of January. February is here. What are you going to do in February? How many deals are you going to submit? How many people are you going to talk to? Go out there to go to Chamber of Commerce, go to meetup groups, go to business association, market yourself, let people know that what you can do. Okay.
Alan,
Yes, sir. Who's this?
this is Mo. One more time. I just want to be.
Mo, you got to give a chance to other people, man. No, go ahead. No, go ahead. Mo, go ahead.
No, I just wanted to remind, before you hang up and end the call, just wanted to remind everyone on this call on this Friday to tune in into our Friday night call.
Yes.
We will be rolling out a new comp plan for our gap funding. So it will be a huge, huge, huge increase.
Yes.
That you all would certainly love. So I want to make sure that everybody's on this call to tap into the Sequoia page and just tap into our Friday night call. Okay, there will be a change in the gap funding, and it will be a lot more profitable for everyone on this call. Okay.
Yes, sir. Yes, sir. Teresa's asking, I have a client who wants to buy a CAT scan machine. Which category? Yes, Teresa, you look at the page right here. You see equipment loan right here. Well, we got a loan for everything, right? The equipment loan right here, and then you click on it. So for equipment loan, depending on the price of the equipment loan, if that equipment is less than $100,000, most likely we just need an application and an invoice. As long as that business has been in operation for more than 2 years. Most likely, we don't even need to look at the financial. But however, if the purchase price is more than $100,000, then we need to look at the financial, like tax returns, bank statements, so on and so forth. So fill out that application, fill out the scenario form, and we will get you funded. Okay. Who else? Great info. Okay, great. Wonderful. And who else? I heard another person that would like to ask your questions. Is that Benny?
Yes, that was me. Can you hear me?
Yes, sir. Go ahead.
I was wanting to know if the MICA and the small business programs, is they still viable?
I'm not quite sure I understand. I hear the question clearly. Can you say it one more time?
I said, is the MICA and the small business programs, are they still viable? Are they still in effect?
Yes, absolutely. Anything that on this page is still, it's the service that we provide. Yes.
Okay.
Okay.
All right. Thank you. Okay.
All right, guys. Okay. Can equipment funding be applied to startup? Yes. Very, very good question, Teresa. Yes. Equipment can be applied for startup under a condition. Number one, they have to have a place. They have to have a storefront. They cannot run a startup in their basement. It does not work that way. They have to have a commercial space, a brick and mortar business. Okay. Number two, the maximum funding that they can get, it's up to $50,000 based on credit. Now, obviously, just like Scott said, the better the credit score, the more money they can get. The lower the credit score, the less dollar amount they can get. So again, submit an equipment funding for us, and we can price it for you. Absolutely. And Adele has a question. I have a potential client looking for multi-income stream property, 0.2 acre multifamily, outdoor storage, rental, office space, and so on. They are asking for 1.25 million. I'm thinking we could get them to carry a second. They currently owe about 650,000. Is that anything that we can help? Very complicated right here. So it looks like this is a mixed use. So mixed use. Is he buying all different this different property, or in that 0.28 acre, it has the multifamily and outdoor stores, everything inside that 0.2 acre. So again, I cannot answer that question right here. So please give me a call. We can talk about it in detail. I need to understand exactly what it is. Margaret is asking, CAT scan machine costs about 175,000, 300,000. Purchase must have a percent of perfect. Yes, absolutely. No problem with that. Absolutely. Okay, great, wonderful. Thank you so much. It's 9:01 and we don't want to keep dragging on and on. So thank you so much, everyone. That's another episode of Sequoia Lending. Remember, next week is going to be Electrify California. What does it mean? It means that if you know anyone out there, solar installer, installing solar panels, installing EV charging stations, have anything to do with green energies, bring them online. California right now, there's so much money in California that can fund small businesses like this. If the businesses are willing to turn themselves into a green energy business, there are money for them. So again, that is next week. So ladies and gentlemen, thank you so much and have a great night. See you next Thursday.
Thanks
Good
a lot,
night.
Alan.
Good night.
Night all.